In the last 48 hours, something happened in the silver market that simply isn't supposed to happen in a system this large. 934 troy ounces. That's the category that can be delivered against futures, the part the paper market pretends is always there. 296 ounces in a single activity day, even as the broader market kept behaving like physical availability was tightening, not loosening. Not months, not weeks. In 48 hours, the numbers that backstop the contract structure shifted in a way that forces one uncomfortable question. If the metal that's supposed to settle the promises is moving out faster than it's moving in, what exactly is everyone trading? And here's the part that should bother you. Institutions already see this. They see it in the daily vault figures, in the delivery notices, in the location of bars, in the borrowing costs, in the little frictions that don't show up on a price chart. By the time it's a headline, the easy part is over. What I'm about to lay out isn't rumor. It isn't a conspiracy story. It's a pattern. And once you see it, you can't unsee it, because the physical market is sending a warning that the paper market can't keep ignoring. Welcome to Vault Signals, where we decode what matters before it becomes consensus. Around here, we don't chase noise. We follow flows, inventories, and the incentives that move large players first. If you like analysis that connects the dots while everyone else is arguing about yesterday's candle, you'll feel at home. And as you listen, drop a comment with where you're watching from, because this market is global, and the pressure points don't show up in just one place. Now, let's talk about what actually happened, with dates and numbers, because this is where most coverage gets vague. The CME's Metal Depository Statistics for Silver List report date of February 4th, 2026, with an activity date of February 3rd, 2026. 934 ounces. 832 ounces. On its face, that looks like a lot of metal. 400 million ounces sounds like abundance. But the market doesn't run on the combined total. It runs on what can actually be delivered, and it runs on timing. Registered is what's tagged for delivery. Eligible can be sitting there for someone's account, not for the market. Conflating the two is like counting every car in a parking lot as if it's a taxi available for hire. The existence of metal isn't the same thing as its availability. 296 ounces withdrawn. And when large withdrawals happen into a tight settlement window, it changes the math for anyone relying on the warehouse as a shock absorber. It's not about whether the vaults have some silver. It's about whether the deliverable float can satisfy demand without price doing the work. And price has already been doing the work. On December 29th, 2025, silver saw an 11% intraday drop on COMEX, and the move wasn't random. It came after CME Group increased margin requirements for the March 2026 silver contract by $3,000, taking it to roughly $25,000 from about $22,000. 710. Margin changes matter because they are one of the cleanest ways to force positioning to reveal itself. When margin rises, leverage dies. Weak hands are compelled to reduce exposure, not because they change their mind, but because they can't carry the position. If the market were purely a speculative balloon, a margin hike would simply deflate it, and the story would end there. But when physical tightness exists beneath the paper, margin hikes do something else. They create a temporary release of pressure in the price, while the underlying scarcity doesn't actually improve. It's like stepping on the brake while the fuel line is still constricted. The engine might slow for a moment, but the problem remains. So the central mystery is this: how can the paper market absorb violent volatility while the physical market keeps behaving like silver is scarce, sticky, and increasingly trapped in the wrong places? To answer that, you have to zoom out and recognize an old playbook. In 1979 and 1980, silver experienced a famous squeeze, and whatever you think about the personalities involved, the mechanism was clear. Demand for physical settlement rose into a system that depended on confidence more than inventory. The result was not just a higher price. It was a change in rules, margin policy, and the way exchanges manage stress. Go back further, and you find another repeating theme. When a monetary metal becomes essential to settlement, and the claims on it multiply faster than the available float, markets fracture, the price chart is the last place the truth shows up. The first place it shows up is in premiums, in delays, in lease rates, in backwardation, in location constraints, and in the subtle ways large players start treating physical as strategically different from paper. That's why the more relevant historical parallels aren't only the headlines everyone knows. The parallels are the moments where markets tried to pretend liquidity was the same thing as supply. In 2008, it wasn't silver, it was funding markets. Paper was everywhere, until it wasn't. In 2020, it was gold and logistics. Price said one thing, spreads and availability said another. When trust in the chain breaks, the system doesn't gently adjust. It snaps into a different regime. Now, in 2026, the same structure is forming in silver, and the tell is that the market is starting to behave regionally, not globally. When markets are healthy, a bar is a bar, and arbitrage keeps everything aligned. When markets are stressed, a bar in the wrong place might as well be on another planet. On January 8th, 2026, a major banknote highlighted that this isn't necessarily a question of total global shortage. It's a question of where the metal is held. London, where benchmark pricing is set, has been running unusually low on accessible inventory, while more silver sits in US vaults. That location mismatch is exactly how you get squeezes. Rallies accelerate as investor flows absorb. Remaining metal in the pricing center, and reversals are violent when tightness temporarily eases. The same note put hard numbers on how distorted the sensitivity has become. Under normal conditions, a weekly net demand of about 1,000 metric tons might lift silver prices by around 2%. In the current environment, that sensitivity was estimated closer to 7%. That is not a minor tweak. That is a regime change. It means a small shift in physical flow can translate into outsized price movement, because the buffer inventory that used to dampen shocks isn't doing its job. And while analysts argue over whether the issue is true shortage or bottlenecks, the official London data itself tells a deeper story. 4 billion, equating to approximately 927,254 silver bars. On paper, that looks like an enormous pool. But remember what that number represents: an aggregate of custodial holdings that underpin the OTC market. It does not guarantee that metal is freely available to meet immediate demand at the benchmark price. It tells you the size of the lake, not how much water can be pumped out this week without dropping the level. So who is positioning into this? Not the retail crowd, not the social media narratives, not the people watching a chart and guessing. The institutional movement shows up in what they do when stress rises. They secure optionality and they secure physical pathways. First, exchanges adjust margin. We just saw a $3,000 increase that pushed initial margin toward $25,000 on a key forward contract. That isn't a moral statement. It's a risk response. It tells you volatility is not expected to fade. Second, physical custodians and vault operators show the flows. The COMEX depository report is a snapshot, but it's a powerful one because it shows not just totals, but adjustments and net changes across depositories. 296 ounces in withdrawals, with adjustments shifting categories. That is metal leaving the visible system, not just shuffling between labels. Third, delivery activity signals whether participants still treat futures as a hedging tool or as a pathway to obtain metal. On February 3rd, 2026, delivery notices, the February 2026 silver contract showed 190 contracts issued and stopped that day, with month-to-date activity listed at 2,155 contracts. That is real settlement traffic, not just paper turnover. And when settlement traffic rises during a period of falling deliverable float, you get one outcome. The market has to ration demand somehow. Fourth, policy and trade friction can trap inventory. New restrictions in China beginning January 1st, requiring official approval for outbound shipments, add friction to the global silver flow. Meanwhile, tariff uncertainty can pull metal into the US as a defensive move. You don't need a grand narrative to see what happens next. When participants fear disruption, they stop sharing buffers globally. The pooled inventory becomes isolated regional stockpiles. Now here's where it gets interesting. The dislocation isn't just a chart pattern. It's a conflict between two stories told by two markets. The first story is the futures price. It's liquid, visible, and heavily traded. It can move violently in both directions because it is shaped by leverage and positioning. It can crash 11% in a day because margin changes force liquidation. And it can rally just as fast because shorts have to cover when tightness appears. The second story is the physical market. It's slower, less visible, and brutally honest. Physical markets don't care about your thesis. They care about whether bars can be sourced, refined, shipped, and delivered inside a time frame that satisfies demand. When physical markets tighten, the signal isn't always an immediate spot price breakout, and the two stories are now diverging. Western paper markets can trade as if supply is abundant because a contract is easy to create. Physical markets can behave as if supply is scarce because a bar can't be conjured by a keyboard. This gap cannot persist forever. Either paper reprices to reflect physical constraints, or physical constraints ease enough to bring premiums down. Historically, when that gap is wide and persistent, the adjustment tends to be abrupt, not gentle. Before we stack the evidence, it helps to understand the mechanism that makes silver uniquely prone to this kind of snap. Silver is both an industrial input and a monetary metal, which means it gets pulled in two different directions at the worst possible times. When industrial demand is stable, inventories can be managed like any other commodity. But when investors suddenly treat silver as a store of value, the demand profile changes. Investors don't buy a just-in-time stream, they buy certainty. And certainty is exactly what a stressed supply chain struggles to provide. And inventories in silver have a special complication. Bar form matters. A lot of silver exists as jewelry, small bars, coins, or embedded in electronics and solar panels. That silver is real, but it's not immediately available as the 1,000-ounce bars that settle large wholesale trades. Converting forms takes time. It takes refiners, mints, and transport. So a physical market can feel tight even while aggregate totals look large. Because the usable form in the usable place is what counts. This is why people can talk past each other and both sound right. The truth is that silver can be abundant in the wrong form and scarce in the right form at the same time. That is exactly what a dislocation looks like. Now add the role of futures. Futures markets are extraordinary tools, but they are built on a quiet assumption. Most contracts will be closed or rolled, not settled with metal. That's normal, it's efficient, but it also means the system relies on a small deliverable float to anchor a very large paper superstructure. When confidence is high, that works, because the float doesn't need to be used much. When confidence slips, even slightly, more participants choose to secure optionality to take delivery, or at least to maintain positions that could stand for delivery if conditions warrant. That shifts the psychology, and psychology shifts flows. That's where margin policy becomes a lever. A margin increase doesn't change how much metal exists. It changes who can hold a claim. Raising margin from roughly $22,000 to $25,000 on a major contract forces some players out, and it forces others to post more capital. That can cool a rally, but it can also concentrate positions in stronger hands. And stronger hands are exactly the ones most capable of demanding physical settlement if it suits them. In other words, a margin hike can reduce the number of players while increasing the seriousness of the remaining players. Well, that often makes the next move sharper, not softer. There's another lever that matters even more, and it's quieter. Classification. Registered versus eligible is not a moral label, it's a choice. Metal can be moved between categories with paperwork and intent, but that movement usually reflects incentives. When registered rises, it suggests owners are willing to make metal available for delivery at current terms. When registered falls, it suggests the opposite. Owners would rather keep the metal in private allocation than let it settle someone else's contract at posted prices. In a stressed market, that preference becomes contagious. And then there's location. London is the benchmark, but the benchmark is only as strong as the metal that can realistically be mobilized in London. The LBMA's end December 2025 figure of 27,818 tons tells you the size of the London pool, but it doesn't tell you how much of that pool is already spoken for, how much is in long-term custody, or how quickly it can move to meet a surge in demand. If flows are pulling silver into U.S. vaults for tariff reasons, or if export controls are slowing, outbound shipments from a major supplier, you can end up with a market where inventory exists, but not where it needs to be. That's also why the word seizure keeps appearing in analyst language when markets get stressed. Not because the metal is gone from Earth, but because the metal is not available at the price, in the form, and in the place the contract structure assumes. A seized market is a market where normal arbitrage can't do its job without taking on unacceptable cost and risk. If you want a simple analogy, think of a city during a sudden snowstorm. There may be plenty of food in the country. There may even be plenty of food in warehouses. But if trucks can't move, shelves go empty. Prices can remain official for a while, but the real price becomes the price of immediacy. That's what premiums represent. They're not a different commodity. They're the cost of certainty. So when you hear debates about whether this is a real shortage, the better question is the market behaving like a shortage? Because markets don't wait for consensus definitions. They respond to friction. And friction is now visible, measured, and rising. So let's stack the evidence clearly. 934 ounces. That is the deliverable category. 898 ounces, 832 ounces, 296 ounces were withdrawn from the combined total, whether that metal is moving to private custody to another region or into industrial supply chains. It is leaving the visible pool that the futures ecosystem points to as reassurance. 710, with the move amplified by a CME margin increase to about $25,000 from about $22,000 on the March 2026 contract. If the market were calm and balanced, you wouldn't see that kind of forced compression. The margin hike itself is a tell that the exchange saw risk building, and the reaction shows leverage was high enough that the system needed a reset. $4 billion, around 927,254 bars. That is a massive pool, but it is also the pricing center. If accessible inventories in the pricing center are thin relative to claims, the benchmark becomes fragile. It becomes easier for flows to create squeezes and easier for reversals to be violent. 5% year to date, after more than doubling in 2025. And the estimated sensitivity of price to weekly net demand jumped from about 2% per 1,000 metric tons under normal conditions to about 7% in the current environment. That is the market telling you the buffer is gone. Fifth data point, China introduced new outbound shipment restrictions requiring official approval starting January 1st, 2026, adding a friction point to global supply redistribution. Again, you don't have to guess motives. You just have to observe outcomes. Friction increases the value of location. Location increases the risk of dislocation. Now, what does this mean going forward without pretending we can forecast a precise number on a precise day? Historically, when a commodity with a monetary component experiences a location-driven squeeze, there are a few pathways, and the market tends to move between them, not choose just one. In the conservative scenario, the system finds relief through flow. Policy clarity reduces the incentive to hoard in one region. Metal drifts back into the benchmark center, premiums compress, volatility remains elevated, but the market regains some integration. In this scenario, the key indicators to watch are vault flows back toward London, easing of delivery stress, and narrowing spreads. In the moderate scenario, the market stays fragmented. Metal remains stranded, where it is safest or most useful. Physical premiums remain high in certain products and regions, while the paper price whipsaws around positioning. The benchmark keeps acting like a weather vane. It turns sharply with each gust of flow. In this scenario, watch the sensitivity. If small changes in demand keep creating large moves, the buffer is still missing. In the aggressive scenario, settlement stress forces structural change. That doesn't necessarily mean default. It can mean rule changes, margin adjustments, delivery incentives, or shifts in how participants choose to hedge. It can mean the market quietly acknowledges that paper liquidity cannot substitute for physical availability, and prices adjust to pull metal out of hiding. The core point is simple. When the physical market sends repeated warning signals, withdrawals from visible stocks, high volatility prompting margin hikes, rising sensitivity to demand, and growing regional friction, the probability of a calm, stable, nothing to see here environment falls. And this is the divide that matters. It's not about being smarter. It's about paying attention to the right layer of the market. Most people will stare at the spot price and argue. Institutions watch the plumbing. They watch where the metal is, how fast it moves, what it costs to borrow, and whether settlement behavior is changing. They move first because they see first. Retail moves last because retail is given the story after the positioning is already done. Information gap becomes a wealth gap in every market cycle. Not because markets are unfair, but because markets reward those who measure the right things. A chart is a symptom. Inventory is a cause. When registered silver sits around 103 million ounces and withdrawals start to matter, the game is no longer about opinion. It's about arithmetic. So, keep an eye on the indicators that can't be faked for long. Registered inventory trends, daily withdrawal spikes, delivery volume in active months, margin changes that force leverage out, and regional policy friction that traps supply. If those continue in the same direction, history suggests the market won't stay quiet. It will reprice, restructure, or both. This is Vault Signals, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the physical market is sending a warning. The question is whether most people will notice before the adjustment makes it obvious.